save us. They can't tame us. Don't give them a reason to take us. Time is now, no time to wait up. Keep it raw, uncut, sit down.
Hey, what's going on, everybody? Welcome to the podcast that creates uncut conversations for the culture. Welcome to the Raw Uncut Podcast. I'm your host, Rels. Make sure you guys like, subscribe to YouTube channel 2920 TV. I just recently started a Patreon. That's patreon.com/2920 TV, where you'll be able to view this and other podcasts at a little earlier episodes or earlier dates. But let's get into it right now. Welcome my guest. He's out of Delaware. He's a financial advisor, and we're going to discuss that amongst other things. Welcome, Ron Brown. How you doing today?
I'm good, man. How are you?
I'm good. I can't complain. Thanks for being my guest. I appreciate it.
Yeah, man.
So let's get started. We had a conversation the other day. We was talking about the stuff that you do. You're a financial planner, financial coach. So let's get into it. When did you start?
Yeah, so I started when I was in my second year in college. So I was 19, and I started as an intern. Just kind of wanted to. I guess previous job was working at the movies, and I was like, I want to get a job where I wanted to, like, my main goal in school really was to start a business, and or I guess kind of go back even further. I wanted to be wealthy, right? So I originally thought it was going to be through baseball, So I actually walked on. I tried to walk on there twice, at the University of Virginia. They declined my offer. So I was like, okay, I guess I got to go to business if I'm going to acquire any type of wealth, because sports wasn't going to be the path. So I started as an intern, and I just really wanted to learn about money, because that's what I went to a workshop. They talked a lot about how investing works and, Rule 72, how compounding interest works over time. And when I was listening to the information, I was like, man, I hope my parents know this, because I might be getting an inheritance, because it sounds like, if you start investing early enough, you're going to have a lot of money. But of course, my parents, they were like, oh, this is interesting. Like, I've never heard this before. I wish I knew it when I was your age. And it kind of shed some light on kind of their story. My dad, I'm originally from Virginia. He was a sharecropper. And
interesting.
Yeah, in Buckingham County, Virginia, right? So if you think of slavery here, right? Sharecropping is a little bit better, right?
Not that much, I assume.
Not much. We'll let you stay, but you got to give us all the profit, basically. So basically, his story, like, they worked really hard on the land, and then his grandfather, which was basically his father, he got sick and couldn't work anymore, and they kicked him off the land, right? So he worked, his whole financial future was tied to another man. And when things got rough, they let him go, right? So fast forward, let's say 40 years to my dad's situation. Like, he's in corporate America. He actually managed Kmart's my entire life. We moved up and down the East Coast, and he was right at retirement. Right, he's going to retire within the next 3 years, and they let him go right before he was fully vested with his pension.
Oh.
So instead of getting the full $5,000 a month that he was, planning on, he only got like $400 a month. Wow. So it was like two generations of, like, people depending on other people for their income, and then it getting snatched away. So when they were talking to me about being financially independent and all those words, like, I was like, okay, that's what I'm looking for. This is different than what my family's done. And if I can find a way where I can't get laid off because I have enough money saved where, it doesn't matter, if I'm working or not, my money's paying me. And, I just fell in love with the concept of passive income and, kind of having your money, your assets work for you instead of you always working for your money. So that's why I got started. And that's why I'm still here. I would actually go to class in a button up and khakis and go to appointments after class. I would sit down, and I had this beat up 1985 Mazda 626, that I used to ride around in. It wasn't a nice car, but I would go, and then, like, this kid would come out talking about becoming wealthy and investing their money. So a lot of times I had to deal with talking to people's egos, where they weren't ready to hear that from me. But over the years, kind of perfect your craft and how to come across to people and how to develop business. So it was straight commission, but that's really what I wanted. I figured if I could develop clients and create my own income, then I can, like, no one could ever take that away. Once you have that skill, you can always make more money, but I feel like a lot of times, even like a lot of people, a lot of my, students in the school, like, everyone wants to go get a good job. They kind of want, but if you do that, you're just working for somebody that created a lot of work.
Mm-hmm.
I want to be the person that could create the work. So that's how I got started, long answer to your short question there,
That's okay. That's okay. That's okay. So, explain to people, what is passive income?
Yeah. So, a good way of thinking about it is, in my field with financial planning, is like you have, let's say, a mutual fund. Okay, a mutual fund is like if you buy a stock. So think of like stocks. So a lot of times people hear of stocks, like they say, I'm gonna go buy Amazon.
Mm-hmm.
The issue with that is that all your eggs are in one basket. So if Amazon goes out of business, so do you, right? But if Amazon does well, you make money, right? So, but a lot of times people are afraid of that instance where they could invest their money there and that company goes under. A mutual fund would be like, instead of putting your money in one store or one company, it's like putting your money in the mall. So now it's in 100 different stores. So in order for that investment to tank, or, for you to lose all your money, all 100 businesses need to go out of business the same day, same time, which is possible, but very unlikely, and you would probably see the writing on the wall and you can make moves before that happened, So kind of going to the passive income scenario, would be if you had your money in that mutual fund and let's say it's producing 10 to 12% a year of interest. If you had $1 million saved, that's $100,000 to $120,000 of interest payments every year, right? So let's say when every month you could take out, that $10,000, $12,000 a month and live off that, so that $1 million has become your job. As long as you have the $1 million, you have income, so that's what retirement is now. Retirement used to be an age, like you got to 65 and then the government would take care of you. So they used to call it a three-legged stool for retirement. There would be personal savings, your Social Security, and any pension or anything that you have from your job, right? But three of those are pretty much gone now. Pensions no longer exist. Social Security, if you look at your statement, it says it's going to run out of money in 2035, which is about 9 years from now, right? So
and 9 years moves really fast now with the way time is moving.
It does. So like if you look at your age, you're like, say I'm 40, when I'm 49, there's not going to be any money left in Social Security. So they're either going to reduce the amount of benefits being paid out, or they're going to move the age from like 65 to 70 or 75. So, but the thing is that anyone that's currently getting Social Security, they're probably fine, because there's no politician that would be willing to pass that legislation that's going to take money away from them. But if you talk to anyone kind of our generation, 40s, 30s, we all kind of know we're not getting it, so they'll probably make the changes for our generation. So the only thing we can really depend on is our personal savings and the money that you put away, the assets that you create. So that's one example of passive income. Another would be, let's say you bought properties. So you buy a rental property and you over time, you're sound with your money and you pay that mortgage off. So let's say if they're paying you $3,000 a month in rent, that is now passive income every month. So every month that they have to pay, you get paid, right? Every time so that's a good source of passive income. And then on the business side, what I do, we get paid for the assets under management. So let's say if a person had, let's say if an advisor had 10 million in assets under management, that's approximately like $2,000 to $3,000 a month of income, right? So as an advisor, you focus on building a bigger book of business. So if you had 100 million, you could have, 15, 20, $30,000 a month coming in. I have people that are in the industry are making $50,000, $60,000 a month every month just from managing the accounts, and what they'll do is they'll set up a team of people that actually do all of the customer work, and they just go out and they sit down and they play golf and meet people that need to invest. So sounds easy, but it's work. You're dealing with people, but it's a great way to have passive income. And But yeah, so that's passive income.
Okay. So with you doing this as long as you have, what was it like to try to convince people to invest with you? How, like, was it? I can imagine that it was a difficult process, but once they got confident with you, I can imagine it became a lot easier. But what was that first process like with you becoming a financial advisor and then having to talk people into trusting you with their money to invest?
I think when I first got licensed was really believing it myself, because I didn't want to lose people's money. You know what I mean? Like, you know, like I didn't want people to think I was scamming them, or they're going to put their
whole life savings into you.
Yeah, and then it tanks. And then like when I started in the business was right around 2008. So I don't know if you guys remember that. That was the mortgage crisis.
Yes, it was horrible back then.
Yeah. So I'm like starting in investments and no one wants to invest. You know, but Warren Buffett says that Warren Buffett's was the wealthiest person in the world at one point, but he's an investor. And his investment philosophy is when people are fearful is when he's greedy. And then when people are greedy is when he's fearful. So meaning when everyone wants to do something, that's when he doesn't want to do it. But the opportunities are there when people don't want to do it. So for example, in 2008, they started Berkshire Hathaway, which is his company, their real estate arm, back when no one wanted to be in real estate because prices were down, you know, and they invested heavily in that. During the recession, they invested in railroads because they're like, okay, when we come out of the recession, we're going to need to be transport goods across the country. So I think a big part of what I do is kind of teach people how to think like an investor and not a saver. Because as a saver, you want your money to always be there. You know, if I put away $100 and I'm saving at the bank, I better have $100 when I come back, right? But what you don't realize is what you're giving up by only wanting to come back to what you started with. You know, because as an investor, it's going to fluctuate. Like the market's going to go down, but inevitably it will go back up. So you got to understand why it's going down. So I needed to understand that for myself so that I felt comfortable investing people's money. So I started investing myself. You know, I wanted to be able to tell people like the investments I'm talking to you about, I own. Okay. So I tell my clients now, when I freak out, that's when you can freak out. You know what I mean? Because we're all in the same boat. You know what I mean? But if you call me, you're reading the headlines and I'm like, hey, how's it going? You know, you watched the game last night, then you're good. You know what I mean? Like I'm not, you know, but when I panic, that's when we panic. Right. So yeah, that's so early on, like I started out, like you can start a mutual fund as low as $25 a month. So you don't need to have a huge lump sum. So I think a lot of times people don't start investing because they feel like they need to have $20,000, $30,000, $40,000.
Oh, okay. I'm sorry to cut you off, right?
Yeah.
I'm glad that you said that because like, I think for a person like me, the fearful thought is when investing in stocks, one, not knowing where to invest your stocks. There's so many apps that tell you where to invest your stocks. So you're kind of a little confused at that point. And then I'm of the impression, and maybe you can tell me I'm wrong. I'm of the impression that when you invest in stocks, like if you invest, like say, for example, like shares, I don't really know the process of how these shares work, but I do know like shares, it's the more shares you have, the more money you make, right?
Yeah. So think of a share as like, I think like when you think of buying stocks, like people don't really get what they're buying. You know what I mean?
Exactly.
You know what I mean? So like you're buying a piece of Amazon, right? So you own, or if you buy Starbucks stock, you own Starbucks, right? So they better spell your name right on your coat. You know what I mean? Because
they don't half the time.
No, they don't get it. You know, I got an easy name too. They still don't get it. So so the thing is that when you own a share, that means you own like if they have 1 million shares outstanding, you're 1/1,000,000th of an owner, but you participate in the growth of that company, you know? So think of it more tangibly. It's like you own a house. Okay. So you own one house of Amazon, right? So I have one of those, right? So that's worth $100. So if the share price goes up to 110, now I have $110. So I made 10%. Yeah. So think of it that way. So a lot of times what people do when they when they buy them, they say, all right, the market's going down today. The news, if you guys, you know, I'm sure you noticed that bad news sells.
Of course. Controversy creates cash.
Yeah. No one really cares about I remember like the format of news before it would be like, 30 minutes of drama, and then you got 30-second feel-good story at the very end.
Mm-hmm.
Yeah, just so you don't like, so you come back tomorrow. You know what I mean?
Mm-hmm.
To get more.
Squeeze it right after the sports.
Yeah, after the sports, and you're like, oh, look at this lady, she turned 105. You know,
Mm-hmm.
and like, that's nice. On to more drama, right? So, so I feel like with the news, you don't really get good investment advice, because if it's in the news, it's already in the price. Like, it's too late. You know, if you're reading the headlines, it's already priced in, right? So, so it's more so a philosophy on, I'm going to buy things that people are spending money in. So, for example, the market could go down only because people are unsure. So, like, the market moves by uncertainty a lot of times, not the value of the actual company. So, for example, when we started the Iran situation that we're in now, right? People are like, oh my God, what's happening? We're at war again. So immediately it goes down. But then people realize, okay, we're always in war, you know? And then it comes right back.
I don't think people, not to get political, but I don't think people realize that this country's been in more wars in its existence than it hasn't been.
Yeah. It's a perpetual war. You know what I mean? Like, it's become a business.
Mm-hmm.
So I feel like people will react to, like, okay, Amazon went down because of the situation in Iran, but Amazon is still in my neighborhood every day. They're still productive. They're still, like, selling goods. You know what I mean?
Okay, so when did it go down? Because honestly, like you said, I'd never seen it.
Yeah.
Look, I work for the post office.
Mm-hmm.
So
yeah.
I'm delivering packages, and most packages are Amazon packages. I don't see a drop.
No, but they're still productive. So that means that as a savvy business person, you'd be like, okay, there's value there. Like, I'm going to get this stock on sale now. So, like, when the market goes down, it's like Black Friday. Like, we're having a sale at 10% off or 5% off or whatever the downside is. So, but people, for whatever reason, want to buy stocks at full price. If they go on sale, they're like, nope, not interested. I want full price. I want all of it. You know what I mean? And the reality is that you want to do the opposite. You want to buy low, sell high.
Mm-hmm.
You know, but I don't think people quite understand. They just need to have a conversation. Like, all this stuff is, I think, common sense. It's just not common knowledge, because there's a lot of noise out there. You know, you can go on YouTube and get 50 different opinions, and you're like, all right, what's going on? So one thing that you said, like, I don't even know where to start to invest, right? So if you don't have an advisor, what you can do, this isn't an investment advice, because I'm licensing, I can't tell you what to do, right? Mm-hmm. But if you were to buy an index, so the S&P 500 is the 500 largest companies in the United States, right? So basically, they're a barometer almost of the world economy. So how the S&P does is typically how the United States economy is doing, you know, kind of how the world is doing. So the S&P has averaged about 12% annually, going all the way back 50 years. Okay, so the one thing about investing is you can't predict the future, but you can look back in history and see trends. Because, like, 10 years, the last 10 years was very similar to the 10 years prior to that, 10 years prior to that, 10 years prior to that. But what people look at, they look at, like, 1 year. They'll be like, oh man, it went down this year. So it's the market's very unpredictable in the short term. Mm-hmm. Long term, it's very, very predictable. Can't say guarantee. Very, very close though. It's going to make money, you know, because going back. So if you average, why 12% important. If you went and set up an index fund, so I want an S&P 500 index, you should average about 12% a year on that. Mm-hmm. It's not going to run every year though. Like last year, you actually got more. You know, you got like 17%. But then there could be a year like 22, like right after the pandemic, you're down like 20%, right? So a lot of times people will say, oh, I don't want to save now. You know, it's bad, right? But over time, the line is doing this. It's going up, right? So if you average 12 on your money, there's what's called the rule of 72. It will tell you how fast your money will double depending on the interest rate you're earning. Okay, so most banks, they'll give you 3% or less in a savings account. So if you're earning 1% on your account, one goes into 72 times. So that means every 72 years, your money doubles one time, which is highly unmotivating. Mm-hmm. You know, I might as well get that TV.
Mm-hmm. Yeah.
Because I don't got 72 more years. You know, I'm gonna go spend that and enjoy it, right? But if you're averaging 12% on your money doubles every 6 years. Right. So over a 48-year period, right? If you had a $10,000 investment, if you were earning 3% on it, in 48 years, you'd have like 40 grand. And if you're averaging 12%, that same 10,000 is $2.5 million. Huge difference.
Big difference. Right.
So the banks, though, what they'll do is they'll guarantee you 3% because they play off our fear that people are like, oh, I just want to have my money. Like I want to make sure it's insured. Like, I'm gonna go there and get my check. I'm gonna make sure I can. And I'm not beating up on banks. They serve a purpose for like short-term savings. But anything long-term, you can't afford to only get 2 or 3%. Right. So if you're averaging 12, but what they'll do is they'll give you that 3%, guarantee it, but then they'll go out and they'll invest. They'll buy mutual funds. They'll loan it back to us. If you get a credit card with that same bank, they'll charge you 29%. Right. So now your debt is doubling, every 2-3 years if you keep that credit card that entire time. So the thing is that the bank knows that they will get at least 12% on their money, and they'll make that $2.5 million off of your 10,000. So I would guarantee you 10,000 or 40,000 in 48 years, knowing that I'm making $2.5 million off of it. And that's just with one person's money. Everyone else is going to the bank too. So banks rarely go out of business. They just change names. You know what I mean? Bank I started with when I was in high school was Wachovia. Now it's Wells Fargo. You know what I mean? Yeah, they'll eventually be another name, but the money's still there. And they'll maintain and open another bank. So the thing about it is I find that my kind of target market is I want to educate middle-income families on how to become high net worth by managing their funds and investing their money. One of my like most successful clients was a high school teacher, right? And he started actually investing before I met him. But you meet the guy, he is over $2 million. You would not know. You'd have no idea. Yeah, right. And what he did, he said, I just did all the stuff that somebody told me to do this early on. He got his 401k, he invested it, didn't take money out of it, and let it continue to grow. And that's really all it takes. It just takes a long time. It takes years. And a lot of times people get impatient or, life happens. I need that money. I lost my job. I got $50,000 sitting here. I'm gonna access that money first.
Oh, okay. Yeah. So pretty much basically it's just a long game.
Yeah.
So why do banks, like you just said, banks change names, but the money still stays? Why is that? Is it just because that particular company goes out of business, so they just buy it under another name?
Or I think it's probably more profitable for like another bank to like merge with them. Like they probably acquire more assets, but like your money's safe though. You know what I mean? Like for the most part. And the market for the most part is pretty resilient. Like you can kind of look back at the pandemic, which we never experienced anything like that before. But you're kind of you can see with the pandemic where we were faced with like, deadly disease or go out and make money. People are like, man, I got to get out. We're going to find a way to work and make money. You know what I mean? So all the economy is like people's fears when they invest a lot of times is like, what if the economy collapses? All the economy is at its base is people buying and selling things. Right. So in order for the economy to totally collapse means that people are no longer buying and selling anything. Right. And if that happens, do you still need money? And I'd argue that you don't, because we've all seen the movies. When the economy totally collapses, we have The Walking Dead. No one there cares about their 401k balance. They're like, oh, who has the most bullets and who has the canned goods?
How can I survive?
It's a different time. So like when I tell clients, I said the only thing to really worry about is total like civilization collapse. And if that happens, you don't need money.
Yeah, because what's good is your money for that at that point?
Right. He said, I have this safe full of money. I said, we're now bartering. And it's like, I have this bottle of water, which is now worth more than anything, because he's like, I need that. So, so our needs change and then the economy shifts, but even then we'll find a way to create a new economy eventually. So yeah.
It always gets torn down to be rebuilt again.
Yeah. Hopefully not anytime soon.
Yeah, no, I hope not either. I hope not either. So to circle back real quick, how did you like? What was the process of getting your license to become an investor?
Yeah. So in order to do the investments I do, you need a Series 6 and 63, which is a FINRA. It's a FINRA test, nationally regulated body that came into existence because of the stock market crashes in like the 20s, when there was really no regulation at all. Like you could buy a 1 cent investment and pay $100 for it, and no one would tell you what your investment was worth, and then you would be upside down, and then it was just a wild, wild west. So you had to take those tests. They're pretty hard. They're kind of like a weed out test. They don't want people in the industry for some reason. So they make it really, really, really challenging they probably harder than it needs to be, But what I actually did it, I took it when I was in college. So during spring break, I studied for the Series 6 for a week, and then took that one, and then I studied for the 63 the following week, and then took it the week after that. So people take months to take it, but like the reality is like no one studies a month for a test, unless maybe it's like the LSATs or something, but like, or like the practice or something, like a huge test. But most of the time, most of your learning is done 2 or 3 days before when you're cramming, and that's what I was in like college study mode. So I knew how to like kind of lock in, get it in. So I did that. That was 20 years ago. It was right around this time. I was at senior at University of Virginia, and I wanted to knock out the investment license. Before that, I just had insurance license. I was just doing life insurance. But yeah, so that process, that way you can do other people's investments. You can do your own without a license. You kind of got to find good information.
Okay. Yeah. So you said you did life insurance, or you still do life insurance?
I do.
Okay, so can you explain to people, because there are certain people who don't know the difference between whole life and term?
Yeah. So that's a great question. So there's 2 different types of life insurance, like so whole life, and then there's term. So you'll see like different types of like cash value whole life insurance policies, and all of them are basically insurance and savings bundled together. So you pay a premium every month. So you pay money into it. Some of the money goes to protect your life. The other portion goes to build a savings plan, right? My issue with them is that it's a very expensive way to save, because you got to pay the insurance company to invest for you, and they have their hands in your pocket for a few years. So if you're paying like a traditional whole life policy, after 4 years of saving in it, you'll have no money in it most of the time, because all those goes towards expenses, all right? And then after that, you start building a cash value in it. So a lot of times they're sold in a way where people don't like buying insurance, especially life insurance, because if you use it, you're not here no more. You know what I mean? So it's one of those things that people kind of dread talking about, but they know their family needs it. So I think a lot of times it's easy to sell whole life insurance, because you can say, well, if you keep paying on it, you're going to build equity in it. You're going to almost like buying a house. You're going to have some money left over, so that if you decide later on that you don't want the life insurance, you can at least have something to show for it. But term insurance is just protection. There's no savings. It's just money that will be paid out to your family if you die. And it's always less expensive than a whole life policy, or the types that have insurance and savings bundled. Okay. So if you buy term, let's say you want a $100,000 whole life policy on a couple, let's say they're 30 years old, that might cost that couple, $100,000 a whole life would cost them about $250 a month. You could get the same policy in term for, let's say, $50 a month. So what I would tell the person to do is buy that term policy. If your goal is to accumulate wealth. If your goal is to do something else, then you might need that policy. But if the conversation is about accumulating as much money as possible, this is what my recommendation would be, is to buy the term policy, protect your life, to make sure that the purpose of the term policy is to replace my income if I die, that my family still has money, right? Because all we are to our family, other than us they love us, right? We're also a money machine. Every month we go to work, every day we go to work, and every month a check comes in. If we die, they still need that check. right? So the life insurance is there so that that check continues, right? Because most people, especially if you're married, like you build your life off 2 incomes, you can't all of a sudden just replace that. So people will be like, oh, I have 1 year salary at work, of life insurance. They're good for a year, and after that, what do? You got to downsize. You got to, find another spouse. You got to do something. You got to get another job. So the term policy, you get it for $50. You take the $200 difference and you invest that. You will always have more money in your separate investment than you would if you did it through the insurance company. Big reason, because you cut the insurance company out. You aren't paying their expenses. Expenses attack your return, more than the actual market itself. If they're taking 1% a year from your investment, that's going to add up over time. And a lot of times they're more than that. So I see a lot of like people. I think there's certain circumstances where a whole life insurance policy makes sense. It's just, I'd say after you buy a term policy and you're investing and on track. And then I feel like the best use for it is if you have a lot of money and you want to make sure your kids get access to it without having to pay estate taxes, because life insurance proceeds aren't taxed. Right. So if you have a $100,000 policy, it's going to your son gets $100,000 tax free. So if you know that, okay, I have $100,000 I want to give my son, you could, in essence, put it in a policy and kind of skip the gift tax, but you got to pay the fees. So you got to figure out, like, do the fees, are they cheaper than what the tax would be? That's a whole nother conversation for estate planning. You know what I mean? But I think people are buying it. It's the wrong tool for what they want. A lot of people in the industry demonize like one's better than the other. It's just, it's a tool, so if I'm building a house, I might not need the jackhammer, you know what I mean? I mean, the jackhammer's bad, I mean, I'm just not building that right now. But I think sometimes people are also misled into buying them, thinking it's going to do something that it doesn't do. It wasn't designed to do. So you just got to make sure you're educated.
Okay. Yeah. So how important is, like you said, you just mentioned estate planning. So please explain to people, because I really don't think they understand this, but how important is it to actually, and I know because we just mentioned about how nobody likes to really talk about preparing for their death, but how important is it to have those affairs in order? Because, I mean, I hate to say it, but anybody can die at any moment.
Yeah.
And if those affairs are not in order, then your family's left with some tough decisions to make, if they can even make those decisions.
And a lot of times divide the family up because everyone has their opinion on what mom or dad said, and I kind of use a personal example. My mom, she passed away 3 years ago, and she had a will, but like it wasn't updated since I was a baby. Right. So, and then right when we found out she was going on hospice, she was like, you know what? I don't think I want her funeral. I think I want to be cremated. But she said it kind of in passing. Right. But then, like, at that time, you don't want to bring that up again because she's on hospice. So you're like, hey, mom, when you die, what do you want to do? You know what I mean? So you never want to bring it up at that time. But I wasn't sure if that's what she really wanted. You know what I mean? Because she said it kind of but I shut it down. I was like, no, you're not going to die anytime soon. 6 weeks later, she was gone. All right. So we had to have the conversation then. So, but she eventually said, yeah, what I told Ronnie, that's what I want. You know what I mean? So she didn't want a funeral or whatever. But without it in writing, you're kind of left to you're not sure, you're not in really sound mind at that point to make those decisions. What do you really want? And then you might say something different to one person, and if it's not in writing, it's going to be a problem. So I see all the time where people don't have a will. And then there's people that aren't in the will, that are not even really in the family, that they say, okay, this is what they wanted. This is what they told me. And then there's, it's a stalemate. And then if you don't have the will, or if you have the will, it still has to go through probate, where the state's going to tax it. They're going to get their piece of it. So it's important to, even better than the will, is to have a trust, because the trust bypass the whole estate process, and it's a little bit more costly to prepare, but it will make sure all your wishes are carried out. And there's different ways to get a reduced cost. You can get it for a reduced rate. There's legal protection plans that you can purchase. that gives you access to an attorney that will do it for a reduced rate. And it's just one of those things that you can knock out now and never have to think about it again. And it's really, really important because even let's say you have young kids and you have them as beneficiary on your life insurance policy, they don't get it until they're 18.
Mm-hmm.
Right. And then they get all of it at 18. So, 18-year-old me was relatively responsible, but
18-year-old me wasn't.
Yeah. I like spinner rims too, though. You know what I mean?
That's what I'm saying. 18 years old, again, let's just say, God forbid, parents pass away. 18 years old, you now come into all of this money. You're not thinking clear, honestly. And then you may have friends that's like, oh my God, you got all this money, let's go spend it. You're not now you want to be the life of the party. You're not thinking. All that money can go as quick as you got it.
Gone immediately, so they're not thinking about buying a home or investments or properties. But with a trust, you can say exactly how it's paid out. You can say you get this after you finish college and you get $5,000 a year or $10,000 a year once you do this. So you can really control it, make sure your wishes are played out and that they don't blow it, just because the kids, but one of my clients, he's a really smart kid. Like he has a very similar situation, but he called me and invested it. And like, he's just really, really smart. Really, like he's like, I know this needs to last me through college. I need to make sure it's invested properly. And, and it's the cool thing about the market is that you can take money out, have a good day in the market, and goes right back in. It regenerates, especially in good times like we are now, even though things aren't great, but the market's going well,
Yeah. So, so you being an investor, what was your first investment?
So it's the ticker symbol. This isn't a recommendation. Actually, don't buy it now. It's SHRAX. It's a Legg Mason Aggressive Growth Fund. At the time, it was averaging like 20% a year. And I started at that time. You could do $50 a month that I didn't have. That I asked my parents for the first couple months. They invested in my investment, and then just consistently put money away in there. And then over time, as you get more money, you find other investments and put them in there. But I was always big on mutual funds because you can own, like if you have $50 to invest, you can't buy that much stock or that many stocks. Like for example, if you wanted Berkshire Hathaway, it's over $100,000 a share. So, but if you have a mutual fund that owns Berkshire Hathaway, you'll get a proportionate, like a fractional share of that company. So you can diversify $50 in a mutual fund. You can't diversify it in stocks.
So what? Yeah, okay. So what is the difference between mutual funds and stocks?
So a mutual fund would be, or a stock would be just an individual company. So you buy Starbucks, you buy Amazon, you buy Facebook. You own that one company. So everything is riding on Facebook doing well, right? Mutual fund would be like, I have a portfolio that has all of the large cap companies. So I have NVIDIA, I have Amazon, I have Johnson & Johnson, I have Walmart, Amazon, all these name brand companies that we've all heard of. So now my money's diversified amongst this whole pot. If the market does well, I do well. But let's say Amazon went out of business. I still own Facebook. I still own these other companies, and we'll just replace it. You know what I mean? So it gives you some flexibility where you don't have all your eggs in one basket.
Okay. Would it be a big drop though? Like say, for example, if Amazon went out of business, but you still have those others, would you really see a dent in your money put into the stock, to the mutual fund?
Depends on what percentage of your portfolio it is. So let's say it was like 10% of it, you see 10% go.
Okay.
Yeah. If it was 1%, not much.
Okay. So how good are these apps when it comes to investing in stocks? Like say, for example, like a Robinhood or something like that.
It's good as long as you know what you're doing. So it's as good as the user, So, but take some time and read up on and I know a lot of people don't read, like after high school, but go on YouTube and but a lot of it now, like you can go on ChatGPT and type in "build me a portfolio," and it'll be better than like just doing it on your own. Like like, it's not terrible. I'm not telling you to go do that, but like, it's better than like just winging it on your own, you know? And then there's a book that I read, I forget the author, but it's called Simple Wealth, Inevitable Wealth. It's talking about the strength of investing in equities. So when you hear equities, think of like owning companies, right? So an equity means I have ownership in a company. A debt investment is like owning bonds. So basically a bond is that company wants to lend money out and they'll pay you interest. So it's kind of like you are the credit card company. So like you're loaning out money. So if I buy a bond, I'm putting $100 into Amazon and they're promising to pay me back $105. So they're going to give me 5% interest on my loan. You know, and then when that comes due, I get my money. You know, so those are debt instruments that people will use in their portfolio to kind of stabilize it. Because like a lot of times when the market goes down, the equity market goes down, the bond market will go up, or you'll see gold go up. So like gold did really well last year. Like it was like, but or like if you're in a time where interest rates are going up or down, you know, people like different markets will respond to those. So, but I'm more of like the thought process that you need as many equities as possible if you have a long term to save. You have a long time, like if you have 20, 30 years to invest, then you need to be in companies because you're going to, historically speaking, you're going to make the most money there.
So what would you say is probably the biggest misconception about being a financial coach?
I'd say that, I don't know, misconceptions. I think a lot of times that we're like out for their money, you know what I mean? Like, you know, and it's not that, you know what I mean? Like we don't make any money or we're not making decisions. Like when your account goes down, we don't want to see that happen. You know what I mean? So we're not, but they're not, we're not the type of person, or, you know, the good ones are going to act in your best interest. So, you know, we take tests, we have certifications to say that we're going to do things, you know, to the client's best, you know, their best interest. So I think a lot of times they might feel like we're selfish or greedy or, you know, making a ton from them. But a lot of times you don't make that much money from like helping someone. If I help someone invest $50, I'm not making anything. You know what I mean? Like it's like you need to invest it though. You need to do that. It's not like a lot of like early on, it was like almost charity work. You know what I mean? Like I'm, you know, like invest $50, I make 50 cents. You know what I mean? Like it's not, but the thing is like, if I made a lot of money on that, how's the client making money? You know what I mean? You know, so I think another misconception, I think like fees are important, you know, part of your return, but sometimes I think people make too big of a deal about them. I know I mentioned earlier about the fees on like the life insurance side, but I still think that it's important to, if you need the advice, to be willing to pay for it. Yeah, but I think sometimes people are not willing to pay for the advice and then they never get any. And then they're out there kind of struggling. You know what I mean? So, you know, if you don't know what you're doing, you know, pay to learn. And then after some time, if you pay attention, you can learn and not really need the advice anymore. You know, but most people left to their own devices, they watch the news and they react and they sell at the wrong time. They try to time the market. So today is a good time to invest. Typically it's time in. The longer you're in, the more you make. You know, it's not the timing of it. Like, hey, I got in the right time. You know, it's too hard to predict that way. So if you have people telling you that they know, they don't. Because if they did, they don't need your money. They would put their own money in and do it.
Oh, but yeah, that's true. That makes a lot of sense when you think about it.
Yep. Like they would just time it themselves and then go move somewhere. You know.
So what advice would you give to someone, or not even advice? What would be the pitch you would give to someone if you would want them to invest? Well, if you would want to be their financial coach, like what would you tell them to get them to be like, okay, I'll give this guy a shot?
The funny thing is, it's more so being interested in them. So like my approach is like, all right, what is your goal? Like, where do you want to be? You know, like what do you want retirement to look like? You know, how much money do you have coming in? So it's more of a process of asking those questions, and then okay, these are the tools that get you there. So I think that might be a misconception too. Is it's never a pitch, at least not my way of doing it. It's more of like a educational process, because I don't want it to come across like I'm a used car salesman. You know what I mean? Like, oh, like you got to do this, you got to get in quick. You know what I mean? Before the market goes down. It's all about them. Like, where are you right now? Where do you want to be? And what can you afford to do? And let's work together. And then with me, it's a lifetime partnership. Like we're in it together. I'm not going to put you in an investment. You never hear from me again. Like you're going to hear from me all the time. I will call just to say how's it going. Like some of my best clients, we talk more Eagles than we do finances. I'm in the Delaware, Philly area. So big Eagles guy. Oh, you're a New York guy.
No. I'm actually a 49er fan, actually.
Yuck.
But,
Yeah.
It's better than being an Eagle fan. But anyway.
Yeah.
It'd be probably better than being a Sixer fan too, but we're not gonna talk about that right now.
Right.
So what do you think is the bigger blame for society at this point when it comes to, let's just say, for example, people retire, but it seems like people are going back to work. Do you think it's like because they mismanaged their money, because they never really had any money, their knowledge on how to do stocks at the time?
Yeah.
Like, because I've noticed that a lot of people now, like people who are way older than me, they retire from one job, work the job 30, 40 years, and then they find themselves going back to work again.
I think sometimes it's out of, I think corporate America a little bit, like looking at the pension plans, and they're like, these are too expensive, and kind of shifting out of it. And people still acted as if they're getting a pension. You know what I mean? Because like a generation ago, you got the pension and you got Social Security, but people didn't live as long. So like, it was a big deal to see someone live to 100. Now it's not really a big deal. You know what I mean? You notice that? Like it happens all the time. So like life expectancy has gone up, which makes it more expensive for the companies to have it. So they shifted the burden of retirement on the person, but they don't really teach us how to do it. None of this stuff is taught in school, but we're guaranteed to have to know how to manage our money. Like it's something that like I haven't had to solve for X yet, in my life, but I learned a lot of that for a couple of years in high school. You know what I mean? But very little was taught on personal finance. So I think it's a lack of knowledge, and also procrastination. People feel like they got plenty of time. You know what I mean? But if you start early, like if you start saving like in your 20s, you can save from like 22 to 28, max out an IRA, individual retirement account. So there's two types of IRAs. There's a Roth IRA, traditional IRA. Roth IRA, any money you put into a Roth IRA, when you turn 59 and a half, it's yours, right? So that 22-year-old that maxed out their IRA for 6 years and then stopped saving, they have more money than the person that saved from 28 all the way to 62.
That's crazy.
It's because of the compounding interest. You know what I mean? Like you missed that whole doubling period, you missed out on a lot. So a lot of it is lack of knowledge, but then also the debt situation. Like you come out of school and you still have a mortgage payment, but you don't have a house because you got to pay the student loans back. So, oh yeah, I know what to do. I can't do it because I got to pay the government back for this loan. So it's just like, it's kind of it's tough because like I knew all this stuff too. And early on, I couldn't do all the stuff I wanted to do. I felt bad presenting. I'm investing $50 a month, but I don't have a million. I'm talking about getting $1 million. And I didn't want people to ask me how much I had. I got a couple thousand. But I'm working towards it. So that's how. I think a lot of it is just the cost of everything going up. Our payments aren't going up, but then I think people are too dependent on other people to take care of them when you can do things on your own and make a lot more money. And in the country we're in, the capitalism, being a business owner is rewarded. And I think we might have too many employees. That's kind of my thought on it, but not everyone can be a business owner. But a little bit about kind of the opportunity in my field is that they're calling it the wall of wealth. It's actually started already. It's at $124 trillion. It's changing hands over the next 25 years. And this is the baby boomers retiring and passing away. So when they retire, they have to move the money out of their 401ks into their personal accounts. And that's all opportunities for people to invest that money, right? So there's $124 trillion, right? And there's only 300,000 licensed people like me. So that's a huge need, right? So every large movement in the economy over the last 70, 80 years, you can look at the baby boomers, and they were like the ones that were starting it or behind it. So when real estate first took off, the very first time was the baby boomers buying homes. You look at Harley Davidson, baby boomers buying them. America Online, AOL, it was baby boomers house homes. So all these big trends were run by baby boomers. So now big things that are in a big part of our of the growth in our economy is like pharmaceuticals. Who's taking drugs? Older people. You know what I mean? But now they're retiring and they're passing away, and they have to move their assets. So they're saying like millennials are getting like 45 to 50 trillion of that, which is my generation. Us in our 30s and 40s, early 50s. So it's just we need more people that are educated to teach people how to do the investing. So I spend a lot of my time now actually recruiting and developing and hiring people to be advisors.
What is that process like? What do you look for in a person when you're hiring them?
So I actually don't look for financial people. I think it's more of a mindset I'm looking for, not a skill set. So I'm looking for that person that might be working their 9 to 5 and know that they need more. You know what I mean? Like they're just like, this isn't cutting it. Like I'm not cut out for this. I work too much, don't have any money. They want something legit they can do to make more. I'm looking for the person that just kind of just jaded by the whole system. Like they say, I want to be my own boss. I want to be an entrepreneur. That's the type of person that does well with me. Which is probably a lot of people want to do that, but I feel like it's kind of like the gym. Working in our field, it's you don't have to work. You know what I mean? Like you don't have to come. Like if you're an entrepreneur, you don't have to do it. So it doesn't mean the business doesn't work. It just does the person have the work ethic to do it, because you got to go and hunt and find your food. And I think where a lot of people are accustomed to having it provided. So looking for people that want that and realize that they'll get more if they can control it.
Yeah, that makes sense. It's more like looking for the go-getters.
That's it.
Because if you sit there and you're looking for someone who feels like they got it all already, then what are they really working hard for? Yeah,
I can't motivate them. You know what I mean?
Yeah, and you can probably see that right off the bat, right?
Yeah, just like this type of stuff they ask, like what are the benefits like, what are the hours, what's work-life balance? Like when you start a business, like there's none of that. Like work-life balance, like it's work, and but if you're disciplined and like work early when I started the business, I felt like being self-employed, I worked when I felt like it. But it was the opposite. You need to work when you didn't feel like it.
Yeah. Okay. Yeah.
You know what I mean?
Like, what you're saying. On the days when you don't want to do it, you got to do it more.
Yeah. Yeah. But like you felt like, I don't have to do it because this is why I'm in business for myself. I can come and go as I please. You'll get exposed. First couple of years, exposure. Wasn't great. But I learned and realized, okay, I need to like treat it like a job until it pays me like a business.
That's actually a good way to look at it. Treat it like a job until it pays you like a business.
Yep.
That way at that point, that's where you go back earlier when you're saying now your money is working for you now.
Because I heard from one of my mentors, he said like people confuse flexibility with freedom. So like flexibility is like I'll kind of describe my kind of work life early one. I would go to the gym in the morning, come home, make a couple calls, go back to the gym, and then come home and play PlayStation, and wonder why things weren't happening. You know what I mean?
Mhm.
And then I had the flexibility where like, you'll find out in the business, once you get some skill, you can sit down with a client and make 10 grand and my mind at times, I'm good with bills for 2 months. So the work ethic would go down.
Mm-hmm.
You know what I mean? And then, okay, now I, kind of BS for a little bit and then get back on it again when you need the money, as opposed to just like being consistent and building something,
Mm-hmm.
But then freedom is where, you have the ability to go like make that 10,000, but instead of you doing it, you say, I have one of my guys do it and I'll make money when they do it. So instead of me making 100% of the commission, I'm willing to make 50% to not do it.
But you're still making something, even though you're not doing anything.
Right. And then you have like a system that does financial services as opposed to you doing financial services.
Mm-hmm.
You have a business that does financial services as opposed to you being the financial services person. That's the difference between a business owner and a self-employed person. You have a system that works whether you're working or not. And that's the dream there, is to be free of work.
That's the end goal for everybody.
Yep. That's what retirement is, And
that's what the real word of retirement is.
Yeah. Yep. And it can happen as soon as you want it to. If you have a business, it could be in your 20s.
Mm.
It could be in your 30s if it's built well and profitable.
All right. So yeah, thank you for being my guest. I appreciate it. We definitely gotta have to tap back in because I feel like there's a lot more we didn't scratch the surface on yet. But I asked this question before I end every podcast, so I'm gonna ask you the same thing. You being as successful as you are now, but having to deal with all of that to get to where you are now, what would you tell your younger self?
That it works out. You know what I mean? Like like what you're doing, what you're supposed to be doing. Stop looking left or right. You know what I mean? Just like focus in and, be focused for like 2 or 3 years. You're not missing anything. Like your friends out there, having a good time, they will still be having a good time in 3 years. You'll be able to join them then with money. You know what I mean? So don't feel like you're missing out, and it'll work out. So that's what I'd say. Is like, yeah, all the discipline, it does pay off.
All right, so thank you for being my guest. If anybody wants to reach out to you for any financial advice, estate planning, life insurance, where would they be able to reach you?
Yeah, you can email me at rvpresidente@gmail.com. We can connect on there, or you can even call me. I am open, so I'll put my number out here: 302-312-4912. You can call, text, we'll talk, and see what you have going on.
All right. Thanks, Ronald Brown. Thank you very much for being my guest, man. I appreciate that.
All right, man. Thanks for having me.
And anytime, man. Anytime. Take care.
All right. You too.
Keep it raw, uncut, sit down, talk it out, come together, we as men don't have to shoot it out.